Hi guys, welcome to today's webinar with me, Fawad Razakzada, a market analyst with Think Markets. Also in the room is my colleague, Victor, who
Hello.
has... Hi Victor, how are you doing?
Yeah, very good. Exciting times.
Indeed, the markets are looking really exciting for a change.
Yeah,
Yeah, so Victor, can you see the presentation before
yeah,
we
yeah.
proceed? Excellent.
Looks
All right.
looks so good.
Excellent. All right, guys, let's begin then. Thank you so much for joining me. My name is Fahad Razakzada, market analyst with Think Markets. You heard Victor there as well, and he will be providing us with some interesting insights in terms of what this jobs report will mean for the markets. And we'll talk about that in greater detail. But just to give you a heads up, this webinar will be kind of divided into two parts. First, we will discuss some non-farm payrolls leading indicators to try and come up with a rough idea of how the headline jobs number may look like, and how this in turn will impact the markets. The second part of the webinar will be all about technical analysis of a few major currency pairs, gold and indices, in order to provide some actionable trade ideas after the jobs report is published. So bear with us, but also don't forget, to ask us questions. There will be a Q&A session at the end of the webinar, but please feel free to write your questions as and when you see fit, because we would like to keep this webinar as interactive as possible, and would rather talk about things that you guys are more interested in or have positions on, than us talking about something that you don't have any interest in. So please help us by writing comments or questions in the chat box, and we'll be more than happy to provide analysis on any particular market you are trading, if time permits, of course. But before we proceed to the live charts, please have a read through the risk warning, and I'm going to read the first paragraph with you. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. All right. So just to give you an idea about this webinar, it happens every first Friday of the month when the jobs report is published. The time of the webinar is at 11:30. So make sure you join us for the next one as well. It's going to be that same time next month. Okay. So we preview the jobs report basically using some of the pre-NFP leading indicators that have been released before the jobs report is published. And we also talk about the likely reaction of the markets. And as I mentioned, we'll talk about we'll talk on live charts, providing you some key levels and ideas about which direction the market is likely to head to. So why is the non-farm payroll so important anyway? Well, the payrolls report has traditionally been one of the most eagerly anticipated macro events for the markets. This is because one of the Fed's mandates is to maximize employment, the other being to keep inflation around the 2% average target. So with employment, when employment is strong and the economy is doing really well, and all else being equal, the Fed is expected to maintain a contractionary monetary policy stance. That is, it will be kind of raising rates, right, to control inflation, and it does not want to overcook inflation. Now, over the last couple of months, the focus has returned to jobs and inflation. Bond yields have been rising rapidly. So the focus has turned to inflation, something which the Fed Chair Jay Powell yesterday said he weren't allowed to overcook at his eagerly anticipated speech. But his remarks caused stocks to extend their recent falls, especially in the technology sector, as the markets speculated that this might mean tighter monetary conditions going forward. So with the record government and central bank stimulus already in circulation, and with investors anticipating a strong recovery in the coming months owing to the rollout of the COVID vaccines, inflation is expected to accelerate. Now,
Yeah, if
Thursday,
I can jump in
yeah,
here,
sure.
yesterday, Powell said that the Federal Reserve will be um, worried about challenging market conditions, and well, be careful what you wish for, because that's exactly what happened after his speech. Conditions have become more challenging. Yields have spiked higher because traders were anticipating that he's going to signal that the Fed is going to be taking some action in order to mitigate the rise in yields in over recent sessions. However, he didn't say anything of the like, and this is why the market is now going to start testing the Fed's patience.
Yeah. Yeah, indeed.
So if you hold the view that the Fed is pushing the markets, it's actually the other way around. The markets are pushing the Fed to do something,
Yeah.
and until the conditions become stressful enough, the Fed is going to resist the push. So it remains to be seen how much the Fed is going to be tolerating these jittery markets.
Yeah, yeah. That's a very important consideration to take into account moving forward. The Fed has always been behind the curve, and so have all the other major central banks. It's always the markets that are kind of forward-looking, and they price things well in advance of the macro events happening. And this is what we're seeing once again with bond yields rising. With investors expecting inflation to return. So with that in mind, the focus will also be on the wage inflation aspect of today's jobs report. If the report reveals an above forecast showing for wage inflation, then this might cause the stocks to fall further and accelerate the dollar recovery. So watch out for the wage numbers as well.
We are basically entering a new period of interpreting economic data, where where good news might actually be bad for the market, because the faster unemployment falls and the higher inflation figures come in, and the economy starts overheating, the market will be pushing the Fed to act, to basically do something in order to stop the economy from overheating. So at this point in time, the return on 10-year treasuries is 1.5%, and inflation is about the same. So investors don't get anything for holding bonds. This is why they're selling, and this is pushing the dollar higher.
Indeed.
And stocks lower.
Yeah. So I can see a question from one of the participants in this webinar. Victor, if you have a chance to read through that, the question, then I'll just continue with the presentation.
Yeah, sure. So the question is, could you explain what is happening in the bond markets and what is affecting their value? So as we were just discussing, the bond markets are getting sold off. Investors are not feeling that the rate of return that they're getting, which is the current 10-year yield, are just above 1.5%, justifies them holding the risk of basically holding US bonds. So they're selling their bonds, and this is driving interest rates higher. And this is what the yield is. It's the interest rate.
The yield has an inverse relationship with the price of bonds. When prices fall, yields rise, and vice versa.
So basically, when investors are unloading their bond portfolios, interest rates rise in order to stimulate more investors to come in.
Exactly.
Because to take the risk.
Yeah.
However, some people say that the Fed could be on the verge of losing control of the bond market, which would be an utter disaster.
Yeah.
And this is where the theme currently is. So what is affecting their value? It's the expectations of investors that that the economy is going to overheat, providing all the stimulus, all these low interest rates, and inflation is going to rear its ugly head and going to start eating into the returns of basically, well, first into the income of the population, because inflation is a tax on income. You could look at it from this point of view, and then you know this is how things are currently unfolding. So we'll see what happens.
Yeah. So in terms of expectations for this jobs report, then the market is not expecting a massive number, expecting just under 200,000, following a disappointing 49,000 the previous month. Unemployment is seen steady at 6.3, and the average hourly earnings index, which is what I was talking about earlier, is expected to have risen by 0.2% month over month, similar to the previous month. Obviously, if we see a stronger number, then that would be good news for the dollar. But in terms of what we have seen so far this week, the pre-NFP leading indicators have been mixed. Okay, so one of the key indicators that I look at, or one of the key indicators that I look at, are the employment components of the ISM manufacturing and services PMIs. Okay, so the manufacturing employment component came in at 54.4. It rose by 1.8 points, which is good news, right? However, the services sector, which is more of a dominant sector in the US, saw the employment component of the PMI fall by 2.5 points. Sorry, there's a typo in the in the slide. It's not 6.5. It's 2.5. Okay. Sorry about that. And the ADP, which is a private, the private sector payrolls report, this also came in well below expectations at 117,000 versus 203,000 expected. So that was another disappointment. So there are more disappointments than beats in terms of the pre-NFP leading indicators, which means that the headline expectations of around 197,000 might not be met this time. Okay, so that's the key risk. But obviously, you have to take both the headline figure and the wage inflation into expectations when taking a view on the dollar or on the stock markets. So some of the trade ideas that I have
just for a second, there is a follow-up question from B3A30. We are indeed referring to the U.S. bond markets. However, the U.S. bond markets tend to lead all global bond markets because it's the largest, the most liquid bond market. So basically, it's affecting yields globally.
I'm also seeing a couple of other points or questions in the chat box, and I think you've taken care of that one.
Yeah? The bond market is rising on bad news. That's exactly what happens when the news is not very good. And investors lose this confidence of reflation.
Yeah.
The market is reacting appropriately.
Yeah.
So yeah, let's get into the trade ideas topic.
Yeah, because I can see a lot of interest
in terms of. If you can wait a little bit, we're going to respond to your question just as we move along with.
Just really quickly going through this last slide here. Obviously, if the NFP comes in well ahead of expectations and wages also beat, I think we would favor looking for like risk on long dollar trades, right? So the dollar yen or dollar Swiss could be the pairs to look for trades. I'm talking about the currency markets here. Okay, so in terms of NFP being in line or beat slightly, I would still look for long dollar, possibly against the Aussie dollar, because the Aussie, as you know, has sold off quite sharply in the last few days because we've seen copper prices also come down along with risk assets like stock market. So that's the key thing to watch, the Aussie dollar, I think. But if the NFP disappoints really badly, then maybe looking for long gold setups could be an idea. Although I'm not too sure about that. But let's go and see some live prices, and we can discuss this a little bit more further. Okay, so I can see a question on the DAX. Let's talk about the Aussie dollar before we talk about the DAX. Okay. This is the Aussie dollar. Previously, we were looking at this shaded region. This was in the previous webinar on Tuesday. I don't know if any of you guys that are here joined that webinar. We talked about the importance of this key support area. Well, it was key support until it broke down here. The Aussie dollar made a lower low. If I can move this down, see this low here? It broke that low, made a lower low. I thought that might have been a short-term deviation, but as it turned out, it wasn't. It was a breakdown because we've broken below that level once again today, and it's starting to move down. We've also taken out the bullish trend line that had been in place since March of last year. This is really important because this is a clear indication that the trend might be turning lower for the Aussie dollar. And if you go to the weekly chart as well, on this time frame, you can see a big bearish engulfing candle last week. And at the start of, as we come towards the end of this week, we are trading below last week's range. So we might see some range expansion to the downside later on in this session, provided the US jobs report doesn't disappoint too badly. So I think the Aussie is looking quite weak, and I wouldn't be surprised if it continues lower from here. So where does it go to? Well, if I'm reading this correctly, then you have to think about where trap traders' stop loss orders would be resting, right? So some of those orders would have been resting below this low. The bigger ones will be resting below this significant low, right? So I reckon that the Aussie could be heading down to below 75.63 in the coming days, possibly as early as later on today, depending on the outcome of the NFP. What do we expect from the DAX? Okay, let's have a look at the DAX really quickly. It's not really a market you would look at on the day when US jobs report is published, but we'll have a look at it anyway, because we want to concentrate on US markets in this particular webinar. For everything else,
well, basically the collateral impact would exist, however, not to the same degree as on the US stock market. So when you look at good news for the dollar, which is a good number, a strong number on the non-farm payroll report, this usually is bad for stocks.
Yeah. So in terms of the DAX, just to answer your question, we have seen some bearish price action in recent days, along with all the other major global indices, with the FTSE perhaps being the exception. The DAX has created this inverted hammer candle off of the previous record highs and all resistance. So in this shaded region, you can see how many times it's kind of failed to break through that area. So this is possibly a turning point for the market, this fake out, as you can see on this on the wick of this candle. So it could be that the DAX has stopped, but for confirmation, I would like to see a lower low. The most recent low comes in at the 13,630, this low here. It needs to break through that low before I turn proper bearish on the
decisively bearish.
Well,
in the current environment, we would we're seeing this very tight range.
Yeah.
And basically if you want to be aggressive, you can pick a direction now. However, it would
Exactly.
be prudent to have a pretty tight stop loss,
Yeah.
because if it breaks out to either side, it could be a
Yeah.
rather significant move.
Yeah. So if you're preempting this a downward move, then make sure to have a stop loss at a level where if the index crosses that level, that your idea is no longer valid. So for me, for example, if I were to short this, I'd probably have the stop loss above the high of the inverted hammer somewhere. Just an idea, but obviously this is not a trade idea. In terms of the US markets, this is the S&P 500 CFD. Which is looking quite starting to look a little bit bearish, doesn't it? Yeah, it's creating lower lows and lower highs, broken the trend line. Like the DAX, it still needs a confirmation in terms of breaking its most recent low, which is here. So if that level breaks, the bias would turn bearish objectively, because then we'll have a lower low. But the trend break and the fact that it's moved below the 21-day exponential is bearish. And so looking at some potential resistance levels then, well, this blue level here, which was the low from 26th of Feb, this level could turn into resistance. So let's color that into red. That's the key level to watch today. And if I duplicate this, another level is the low from Wednesday's candle, because that's where the point of origin of the breakdown happened, right? So the shaded region that I'm going to shade now between these two levels is where we might see some resistance coming into the market today. So ideally, if you're short or if you're bearish on the market, what you'd like to see is a move up to this area and then a breakdown like this. In terms of so it doesn't look quite bullish at the moment, obviously, because we haven't created a higher high, and we need to reclaim this bullish trend line for us to turn bullish once again. So the first thing from a bullish point of view I'd like to see is the trend line reclaimed, either today or in the coming trading days. And once that condition is met, I would like to see a higher high above the most recent high, this high here. So if that level breaks, then at that point, the long-term bullish bias would be reestablished, in my view. So while we are within these two levels, I think the bias is slightly tilted to the downside, given what's happened in the recent days. But it's not full-on bearish just yet for the S&P 500. However, if you look at the other major indices like the Nasdaq is looking quite weak, doesn't it? I mean, it's kind of hit its objective this level here, which was significant support in the significant resistance in the past, and following the breakdown of the trend line, it came all the way down here, as we had expected it might during Tuesday's webinar. So now it could bounce from here, but the potential upside could be limited, and a couple of resistance levels to watch include this level right here, the recent lows, as well as this red level. So somewhere around that shaded region is where we might see some resistance should the Nasdaq 100 stage a rebound. If it gets above that, then that would be the first bullish sign, obviously on a daily closing basis. But a key sign of reversal would be if it recaptures these this double top high here around this red level. So indices overall look bearish as things stand. And this is all to do with the fact that yields have been rising. We've been talking about yields. Let me just show you very quickly. This is the 10-year we've been talking about. So it's been rising since
just about 156. Pretty relentless move since the start of the year, as we mentioned on Tuesday.
Yeah.
And the current positioning in the market is extremely bearish. So yields keep on rising.
Yeah.
With all the stimulus stock and all the will keep monetary policy accommodative as long as necessary. The market is starting to lose confidence in the ability of policymakers to control this market.
Yeah. Guys, are you going to trade any markets? Write it in the questions box or in the chat window. And if you are, let us know your thoughts. And if you have any questions from us in terms of anything we haven't covered so far, maybe we can look at gold and silver because they have been breaking down quite sharply in recent times. And, looking at the daily, let me show you the weekly chart of gold. Gold was still looking bullish when it was above this blue line, the 1800, which was previously resistance. I thought if it can hold above that level of long-term support, then the path of least resistance would be to the upside. But as you can see, over the last few weeks, things have changed. Yields have risen sharply. When yields rise, this increases the opportunity cost of holding assets that pay no interest or dividends like gold and silver. Okay, so that's why gold has broken down. It needs to go back above the shaded region on the top side before we consider, bullish signals on gold. So as things stand, it looks quite bearish. Let me just get rid of this because this is now going to be resistance, right? Not support. So just coloring that in red. In terms of support, I've drawn a B, C, D kind of price move on the weekly chart, with point D coming in just below the 38.2 February trace. Will it get there? Who knows? But the way gold is trading right now, it looks like it's going to get there. It's probably going to go lower than that. Who knows? Because the path of least resistance is to the downside at the moment. And zooming out a little bit to see where the next line of defense might come in. A good level might be around the 50% retrace. If it gets there, that's some miles away from where we are at the moment. So I'm not sure if it will get there, but if it does get there, we'll need to see a confirmed reversal signal to turn bullish on gold again. But right now, the path of least resistance is to the downside. So we favor looking for short setups on gold than bullish setups. And that's because of price action, but also because of macro reasons with yields rising. And when that changes, then sure, we could look for bullish signs on gold once again.
Yeah, however, you don't want to be so just to reiterate, you never want to be fighting the trend, and the trend has been relentlessly bearish over the past really 6 months already. So every attempt on part of gold bulls to retake control has been met with ignition of another selling round. So basically, we would until price kind of stabilizes and consolidates a little bit in a certain point, there is very little. The risk-reward ratio favors the bears on gold currently. Let me put it this way.
I can see a couple of questions on euro dollar and dollar CAD. So let's have a look at those currency pairs, starting with the euro dollar first. The euro dollar, well, we drew two scenarios really. First was, can it hold the bullish trend? It clearly didn't. It looked like it was going to go above that resistance zone at one point. However, the intraday reversal here, creating this inverted hammer, that was a big reversal. Since then, price has broken down, taken out the most recent low, which was this red level here. So there's a breakdown in market structure, and now it's taken out the previous low as well. So it looks bearish as things stand. Okay, so it's taken out that key 120 support, which is now going to be potential resistance. And the path of least resistance looks to be to the downside, with the 200-day moving average coming in at around the 118 handle, which is where we also have this blue line converging as well, which was previous support and resistance. So it looks like the euro dollar may be heading to 118 from here. But we will obviously look for bullish setups as well. And one such level to keep an eye on would be this level here, this black level, because that was the most recent high. Okay, so if it breaks that, then at that point, gold, the euro dollar would start to look bullish once again. So that's the key line in the sand for me at 121.15 ish. In terms of resistance, so the first,
we already have the 119.50, which was previous support, now being resistance, and that's probably the first level which we should discuss. Yesterday, the market came near it, and today it has broken through. So always wait before the close, as experienced traders know. If we manage to close above today, I mean, if we manage to close on the daily candle above the 1950 60 area, that would be probably a sign that we can see a reversal, but it depends on the data that we get today. So if it's a really poor show, if we get a really poor showing and disappointing wage growth numbers, we could see the dollar weaken.
Indeed. So it's data driven. What's going to happen today is mainly going to be data driven. But as Victor mentioned,
so actually you started drawing a trend line from the two recent tops. And,
it didn't look quite good.
We might be entering a channel of some sort.
This channel might look better, I think. These lows and then
we could be, but
so obviously that would be a bearish channel, right? But it could also be a long-term bull flag as well, if you think about it. So don't just because the dollar has been rallying right now, don't assume that is going to continue. Things could change and things can change. The market.
It's just that we are in we seem to be at a cross point, and if the data supports a further strengthening of the dollar, that could be a very protracted and sharp move, because over the past several weeks, shorts on the dollar have been increasing, and decidedly so. And also calls for the dollar to be weakened this year have been, in my book, at an all-time high. Many people just don't believe in the dollar, which to me usually says that it's going to rally.
Let's make the dollar CAD the last currency pair that we're going to cover today, because we have run out of time and I can't see any further questions. If you do have any further questions, now is your chance. Okay, so dollar CAD is at a crossroad, really. The Canadian dollar has held its own relatively better than other commodity dollars. This is because
basically because of oil prices, which have rallied so sharply.
On the back of OPEC's decision yesterday as well. So with oil going up, obviously oil is Canada's major export commodity, and that's why the Canadian dollar has managed to hold its own relatively better. However, that could change if sentiment towards risk assets turn decisively negative. Then the Canadian dollar could drop, which means the dollar CAD could rally sharply. So here it is testing a bearish trend line. And depending on what happens today, we will have a very good idea in terms of which direction in the near term price will head to next. Okay, so right now it's back above the 2020 low, which was this low here. And so if it reclaims that, it will mean that it's kind of taken out the previous year's candles, previous year's low, and it's kind of gone back, right? So that's a positive sign. But more to the point, we want to see a higher high. Okay, so let me just update this chart a little bit because it does look a little bit outdated. So the key level or the key high to look at is this high here, which was the most recent high. If this high gets taken, then we will have our first higher high in place after price had formed a lower low.
I would also argue that the just above 127, we have a double, even triple bottom, you can call it, 2750 precisely. Yeah, that could be a level that triggers some stops and basically opens a move to the upside if bulls manage to push prices. We do have non-farm payrolls in Canada as well today, don't we?
No, it's next week. I checked. Usually
it's next
come
week.
in on the same day, but
I think they were saying that they're going to change the date for the Canadian payrolls just to avoid both reports exiting. Being released at the same time, which is creating excess volatility. So apparently they have done it.
Okay, that's good then, because if you're one of those people that trade the data, and I have traded the data release, it's a bit annoying to have both of those key market moving data come in at the same time, which could sometimes make for a volatile ride. But I'd rather have those come in.
Perhaps too volatile.
Yeah, perhaps too volatile. Anyway, I can't see any further questions, or can I? Let me have a look. How about Dow Jones?
Yeah. Okay. Well, let's have a look at the Dow Jones Industrial Average. You don't even have it pulled up?
No. You know what? I hate the Dow.
You're an S&P. You're an S&P guy.
Yeah. I used to look at the Dow all the time. No, I promise I do have it. It's just that I hate it. The reason I hate it is I used to trade the indices a lot, and I lost quite a bit of money on trading the Dow, so I just deleted it.
Yeah.
You
didn't
jokes
need
aside,
to elaborate, man. It became clear straight away.
Yeah. It's the fact that it's only 30 stocks that kind of skews the Dow when there's a company specific move, which is why I don't really look at this index that much.
So basically, we are observing a similar picture to other indices in the US, which we have already discussed. The Dow is holding relatively well when compared to actually both to the S&P and and especially to the Nasdaq, because there are more companies. There are more companies that are involved in the real economy. That's right.
Yeah.
So we're seeing. Well, they're both real, but one is digital. So we're seeing this key support level, the key trend line that got kind of tested yesterday, and we managed to close at it, not above it, I would say. And assuming we don't get some confirmation today that pushes prices back above this trend line, I would be rather bearish on the Dow, simply because the current market conditions seem jittery. And if we see this positive number from the US payrolls report, we could see a decline, further rally in bonds and further decline in stocks. Further decline, further sell-off in bonds and further sell-off in stocks.
Final question here. Where can you access the recording? I'm not sure if we will put this particular webinar on YouTube, but I think we will, because you've asked for it. But if you go to our YouTube channel, Think Markets, we have all the webinars in here. If you go to the playlists, you'll see the recordings of the live webinars in this. Where's it gone? Think Markets webinar in this webinar. Okay,
Yeah.
in this playlist.
And basically, this is where you're going to find the recording of today's webinar after a couple of hours.
My daughter's getting restless, guys, which means it's time to end this webinar. And thank you so much for
Assuming
joining
you
us.
have no other questions,
Yeah.
this is it from us for today, and we wish you a very, lucky trading session. And be careful out there because it might be very volatile today. It's Friday.
Yeah.
So
thank you, guys, and be
you
careful out
soon.
there. We'll join us next week. Okay. Take care. Bye bye.